Okay, so you want to run a video game store. Walls of cases in shrink-wrap plastic, the hum of a demo unit running in the front window, a kid trading in a stack of old cartridges for cash toward the new release, regulars who show up every Tuesday because that's when new stock hits the shelf. You know every customer's backlog. You are, in some small way, the mayor of your neighborhood's gaming culture. That's the picture. Sounds simple. It is not. Here's what that picture leaves out. The lease you signed based on foot traffic numbers that peaked a decade ago. The fact that the industry's entire profit engine ran on people walking in with a physical disc to trade, and that disc is disappearing. And the fact that the biggest company in this business, the one everyone still uses as the mental model for what a game store is, doesn't really run a game store business anymore. It runs a cash pile with some retail attached. We'll get to that. Before we talk about money, we need to talk about what a video game store actually is, because that phrase covers at least 4 different businesses. There's the corporate specialty chain, which in North America today effectively means one company, GameStop, since it's the only surviving national player. There's the independent, owner-operated shop, usually built around used game trading. There's the retro and collector store, which barters almost entirely in Nintendo, Sega, and PlayStation hardware from 3 console generations ago. And there's the hybrid model, a store that's technically still a game store, but where the actual revenue increasingly comes from trading cards, PSA grading services, and console repair labor happening at a workbench in the back. These are not the same business wearing the same sign. One is a declining national retailer sitting on a multi-billion-dollar cash reserve. One is a local operator whose real product, increasingly, is Pokemon singles and a soldering iron. Which of these you're actually running determines almost everything else in this video. Let's start with what it costs to get in. If you're opening independent, a standalone 1,200 to 2,000 square foot storefront runs you somewhere between $80,000 and $200,000 to open. That splits into 4 buckets: lease deposits and build-out, roughly $10,000 to $25,000, fixtures, security cases, POS hardware, and inventory pricing software, another $15,000 to $30,000. Working capital, $15,000 to $45,000, because you need cash on hand the day you open to actually buy trade-ins, or you have no inventory pipeline at all. And the single biggest line item, the one nobody budgets high enough for, opening pre-owned and retro inventory, $40,000 to $100,000. Distributors don't sell you used games. You have to buy that stock from actual people, one trade-in at a time, or acquire it in bulk lots from other collectors. There used to be a franchise route into this business too. Play N Trade charged franchisees roughly $30,000 up front, with total startup costs of $150,000 to $250,000, plus ongoing royalties of 4 to 5% of gross sales. That model largely collapsed because a business already running on thin margins couldn't also afford to pay a franchisor a cut of every sale. Now here's the price collapse story that shows what happens when the underlying business actually breaks. Game Group was the dominant video game specialty retailer across the UK and Europe, the British equivalent of what GameStop is here. In March 2012, after suppliers pulled credit insurance and Electronic Arts refused to even ship them Mass Effect 3 over payment concerns, Game Group collapsed into administration. It closed 277 of its 610 UK stores overnight. Over 2,100 employees lost their jobs in a single day. What remained of a company that had once been the category-defining national chain sold out of bankruptcy for £50 million, not $50 million a year in revenue. $50 million total for what was left of the entire business. That's what happens when the model underneath a chain of stores stops working faster than management can react to it. Say you avoid all that and buy or build a normal store. Before you sell a single game, there's a layer of costs baked into the lease you probably didn't price correctly. Retail space suitable for this kind of store runs, on average nationally, around $24.69 per square foot per year in base rent, plus another $2 to $4 per square foot in triple net charges, which is your share of the landlord's taxes, insurance, and common area upkeep. Pick an unanchored suburban strip center, and you're closer to $20.85 a foot. Pick a mall, and base rent jumps to $35 to over $65 a foot, and you also sign up for percentage rent, meaning the mall takes 5 to 8% of everything you sell above a set threshold. On top of the lease, add utilities, insurance, and POS subscriptions, roughly $12,000 a year. Add staffing, a manager plus 2 part-timers, around $85,000 a year, including payroll taxes. Run those numbers on a 1,500 square foot strip center store, and your fixed operating costs land around $133,525 a year before you've bought a single unit of inventory to sell. So how does a store like this actually make money? It's not one revenue stream. It's 5 layers stacked on top of each other, and they do not make money at the same rate. Layer 1. New hardware. Consoles are basically a loss leader. Historic gross margins on new hardware run just 7 to 7.6%. You sell a console to get a customer in the door, not to make money on the box itself. Layer 2. New software. Slightly better, 20.7 to 21.9% gross margin. Still thin. Layer 3. And this is the one the entire business model was built around. Pre-owned software. Historic margins here run 46 to 48%. Here's the actual math. A customer brings in a $70 game about a month after release. You offer them roughly $30 in store credit, or $24 in cash. You wipe it down, recase it, cost you about 50 cents, and put it on the shelf for $54.99, undercutting the new copy by $15. Sell that copy and you've made $24.99 to $30.99 in gross profit off a single unit, a margin north of 45%. And if the customer takes store credit instead of cash, they usually spend it right back in your store on something else, so you get a second margin transaction off the same original payout. That loop, buy low from customers, resell high to other customers, was the actual engine of this entire industry for 2 decades. New releases were the traffic generator. Used games were the profit center. Layer 4, collectibles and trading cards. GameStop now runs a PSA card grading partnership, charging $19.99 per submission, and processed over 1 million cards through that program by May 2025. Independent stores lean on trading card singles, Magic, and Pokemon mostly, which carry 40 to 60% margins, well above sealed products 15 to 20%. Layer 5. Repairs. HDMI port swaps, joystick drift fixes, laser recalibrations on old optical drives. Labor heavy, but margins over 70%, and it's a service that, by definition, can't be replicated by a website. Here's the one structural fact that explains everything else in this video. The entire profitability of this industry was never built on selling new games. It was built on the used game trade loop, Layer 3, the 46 to 48% margin business. And that loop requires one specific thing to keep functioning: physical discs, changing hands, over and over, forever. Digital distribution doesn't just take away new sales, it removes the raw material the entire high-margin business depends on. You can't trade in a download. In the US, in 2025, physical software spending fell to $1.5 billion, the lowest level recorded in 30 years, against a total US gaming market of $60.7 billion. Physical media is now roughly 2.5% of the industry it used to define. On PlayStation, roughly 76% of full games are now bought as digital downloads. On Xbox, digital SKUs account for up to 66% of software sales, accelerated by the Game Pass subscription. And the console makers have started removing the disk drive entirely on models like the PlayStation 5 Digital Edition, which doesn't just end that unit's physical sales, it permanently ends that unit's ability to generate a used game trade-in, ever, for the life of the console. You're not watching a slow decline in sales. You're watching the supply chain for the store's most profitable product get switched off at the hardware level. Now for the case study that shows exactly how this plays out, from peak to present, because it's the same company most people already have a mental picture of. GameStop hit its physical peak in January 2012 with 6,683 stores worldwide. In late 2007, its pre-split stock traded around $62 a share, with revenue eventually peaking near $9.3 to $9.5 billion, powered almost entirely by that used game trade loop. Then digital storefronts on PlayStation 4 and Xbox One started eating the supply chain. Revenue fell toward $5 billion by 2020. The stock dropped below $3 a share, and short sellers piled in so aggressively that short interest exceeded 100% of the available public float, essentially a bet that the stock was going to zero. In late 2020, Ryan Cohen, the co-founder of Chewy, bought a major stake through his firm RC Ventures and pushed for a turnaround. Then in January 2021, a wave of coordinated retail buying triggered one of the largest short squeezes in market history. Shares went from $17.25 to an intraday peak above $483 to $500 within about 3 weeks, briefly valuing the company north of $33 billion. Management didn't waste the moment. They sold new shares directly into that spike, raised billions in cash, wiped out nearly all their debt, and built a war chest. Ryan Cohen took the CEO role for zero salary, tying his compensation entirely to the stock. Fast forward to fiscal 2025. Revenue is $3.63 billion, down from $5.27 billion just 2 years earlier, and store count is down to 2,206 worldwide. But operating income actually turned positive, $232.1 million, up from a loss the year before, mostly from slashing overhead rather than growing sales. Net income hit $418.4 million, and the company is sitting on roughly $9 billion in cash, securities, and Bitcoin. GameStop, today, is a shrinking retail chain that happens to be one of the more well-capitalized companies in America. Those are two different facts about the same business, and only one of them is about running a game store, which brings up why anyone with real money would touch this. It's not a bet on the store economics, because the store economics are structurally declining, and everyone involved knows it. The reframe is that GameStop's current value isn't coming from selling games at all. It's a capital allocation vehicle, run by an executive who took no salary and is instead betting his own equity stake on where to deploy a multi-billion-dollar cash pile currently parked partly in Bitcoin. Retail investors bought a meme in 2021, and whether by luck or design, ended up funding a treasury company that happens to still operate some stores. That's a very different investment thesis than this company sells more games than it used to. So does running one of these stores actually work? Depends entirely on which version you're running, and the honest math on a normal 1,500 square foot independent store looks like this. Fixed costs, rent, utilities, staffing, insurance, run about $133,525 a year, regardless of how good or bad the year is, because your landlord doesn't discount rent when trade-in volume drops. In a good year, strong TCG demand, steady grading submissions, decent used game supply, you might do $520,000 in gross revenue at a blended 32% margin. That's $166,400 in gross profit against your $133,525 in fixed costs, netting you around $32,875 for the year. In a bad year, trade-in supply keeps thinning as more consoles go diskless. You're discounting harder to move inventory. Revenue drops to $380,000 at a blended 27% margin. That's $102,600 in gross profit against the same $133,525 in fixed costs that don't move an inch, and you're down $30,925 for the year. Same store, same rent, same 2 employees behind the counter. The swing between a decent year and a losing one comes down to a single variable you don't control: how many physical discs are still circulating out there for people to trade in. That's the real inheritance you take on when you buy this business. Not the shelves, not the cases in shrink-wrap plastic, not the demo unit humming in the window. You inherit a countdown on the one thing that ever made this profitable, and it's a countdown that started the day the first console shipped without a disk drive.